Well, good evening, ladies and gentlemen, and welcome back to Foundations of Stocks and Options. Tonight, we have made it all the way to class number 6 in our level 1 program, and that means that we have made it to creating your very first trading plan. So this is going to be an exciting class, and I hope that by the end of tonight's class, what you're going to see how all the stuff that we've talked about in classes 1 through 5 start to come together, and we have a basic trading plan. Now, I don't want to to set unrealistic expectations. This is not necessarily your ultimate trading plan, but if you have never had a trading plan, this is going to be a very good start for you. And it's going to give you the foundation that as we move forward, you can start to add the other elements of the teachings that I'm going to be giving you into this plan. So let's get started here tonight. Here's our program, or here's our agenda. We're going to talk about the components of a trading plan. We're going to talk about putting the plan together and then executing the trading plan. All right, so let's get rolling here with the components of the trading plan. Before I do that, let me see if I have some commentaries that I need to address here. First of all, if you've not downloaded, let me say that different. If you've not opened your email with your notebook for tonight, you need to do that. I found out why those notebooks have not been posted up to the membership area, and they're not going to be posted up until about 2 weeks from now. And the reason for that is because of some of the transitions that we're making, and they couldn't have both of them up there for some reason they gave me. But anyway, once we're done with this whole cycle of classes, which will happen next week, we're gonna swap out all the lessons, and you will only have the new lessons in there. So give it about a week or so, and those will be posted up in the membership area. Until then, if you would download them, or not download them, but print them from your email, that's going to be the way to get a hold of your notebook. So that was an important note for you tonight. Also, Kevin wants to know, what about the election consequences? Kevin, were you in Power Trader Sunday night? I won't spend a lot of time on this, but I'll just quickly address it. Historically speaking, in midterm elections, in the second term of a presidency, the market, regardless of who wins, the market appreciates about 20% whenever you're in a situation like what we're in right now, historically speaking. And by historically speaking, I think that those numbers go back to like 1928. It's ridiculous. And so, Kevin, seasonally speaking, the market should rally. If we look at historical numbers. Now, what's interesting about it, I was talking about this with a friend of mine this morning who's a fund manager, and we were talking about this issue, and he said, he has the same view that I have. He says, the technicals tell me that this is a bearish market. And he said, if my seasonals were telling me that this was a bearish market, he said, I'd be shorting the crap out of this thing, and I'd be betting the farm. But he said, the problem is I've got bifurcated information. And that's what I said on Sunday night in Power Traders. We've really got bifurcated signals. And so, I don't know for sure how much I believe the seasonals, Kevin. And I got enough information that's slightly bullish that conflicts some of my bearishness that I've got. So, Kevin, I think we're pretty neutral right now, and we just need to wait and see how things shake out. There's my short answer to your question. How's that? I will say this, historically speaking, it actually doesn't matter who wins the election. Politically, people care. We get really emotional about our own personal biases about what we want to happen politically speaking. But ironically, the market, in a lot of ways is kind of agnostic to that. So, just take that for what it's worth. All right, let's talk about the components of a trading plan as we move forward here this evening. Let's talk about the purpose of a plan. The purpose of a plan is most of all to limit our emotions. What does that mean? Well, realize whenever we trade, the moment that we make a decision to buy or to sell a position, and maybe I should clarify, the moment we make a decision to either go into a bullish position or go into a bearish position, whether that be buy long or sell short, or maybe if you're trading an option to buy a call or to buy a put, the moment you take that position, you immediately have emotions on the line. Immediately you're emotionally involved in that trade because you've got a bias. You just put something in there. And so the benefit of the trading plan is before we ever get into the trade, while we have some balance to our rational thought, taught, we can put a plan on paper, and that will, in the process of the trade, help to limit our emotions. And it doesn't eliminate them; it just limits the way they can get in the way if we write the plan and we follow it. What the plan will do is it will help guide us to make the right decisions when we need to make them, and it will tell us what to do when we get in trouble. There's a brilliant statement that many of you have heard before. It's called "Failure to plan is planning to fail." I don't know who the genius was that thought this statement of, but it's a true statement. If you fail to create a plan, you are truly planning to fail. And so it doesn't take a lot of time to put a little trading plan together, but you got to have one if you're going to consistently see profitable results. There are 3 minimum components that go into a trading plan, and without these 3 pieces, you truly do not have a plan. But if you have these 3 pieces, then you're moving way down the road to being successful. So here they are. You got to have an entry, you got to have a target, and you got to have a stop. An entry, a target, and a stop. Now, in addition to these pieces of information, you could go a step further, and you could add a few additional things, such as you might have some criteria that need to be met before you'll execute the trade. You may have things like overall market conditions that you're looking for to be met before you'll execute the trade. You may have some other data that you feel is important before you execute the trade. You may have some things as it relates to an option, for example. You may want to add what kind of open interest is there, or maybe some other indications that might tie into the option trade. But generally speaking, the entry, the exit, and the stop, or I should say the entry, the target, and the stop, those are the 3 pieces that you've got to have a plan. And then the next step is you need to have a journal. You need to have a way to document it. Once you've written your plan, once you've come up with your information, you need to write it down so that you've got it. Now, people often say, what should a journal look like? And my answer is, I really don't care. A journal's frankly somewhat personal. I've worked with many different variations of journals, everything from just a plain piece of notebook paper to, Moleskine journals, to I've tried to create some pretty fancy stuff. At one point, I put together a nice fancy spreadsheet. I hated that. I personally hate the computer documented kind of stuff, but you can put something together that works for you. I've got several examples in the back of your notebook tonight. I've got 2 that we're going to look at here in class, and then there's a few others that some students have submitted, and we just decided to include them. If any of those help you, you're welcome to use them. If they don't, it's no big deal. What I do want you to understand is that you need to have a journal, and you need to make something that's going to work for you. And if electronic works for you, then great. If handwritten works for you, then great. I personally, as I've already mentioned, prefer a handwritten journal. I personally feel like when you start to write stuff by hand, it takes on a different meaning to you. I used to hear this said, and I never believed it, and then I started doing it, and I understood it. And, it's hard to explain, but the truth is, if we've got a bunch of thoughts that are going on, those are just thoughts. But the moment we put it on paper, it's like those ethereal thoughts suddenly become tangible. They come into the real world, and now that's a real world thought that's in this real world. When you leave it in the electronic realm, it's kind of somewhere in the middle. It's kind of stuck there. And so I personally prefer, for things that are related to journaling and to ideas, to usually write them down by hand more often than not. But the important thing is that you keep a record of it, and then you use that journal to reference your trades and to improve what you're doing. As I mentioned, there's several in your notebooks tonight that you can work with. This is one variation. This is a very simple variation. You can print it out just like this and use it, or this is really what I used for years. And sometimes I still use something like this. I would just draw it out on a piece of notebook paper. I just say, okay, here's the date. This is the entry. Here's my target. Here's my stop. And you just write it out. That is a fine way to do it. You can turn that whole thing on its side, so you have entry, target, stop vertically instead of horizontally across the screen. Any way that it works for you. Another journal, and one that I prefer a little bit more, is this one here that we kind of put together a couple years ago. I like this particular layout for a couple of reasons. One reason is because you've got your entry, your target, and your stop visually the way that it lays out. So for a bullish trade, you'll have an entry price, your target will be above it, your stop will be below it, and I like that. So let's say that you had an entry price of $98.42, and let's say your target was up here at 104, and your stop was in here at 96. And so visually, this lays out exactly like it would on the screen. Then down here, here's your date. So today's 11/4, and let's say today's current price is 97.20. I'm making these numbers up, by the way, in case you didn't figure that out. And then below it, let's say we had a bearish entry that if the stop drops down to, let's say 93.50, then we'll go bearish, and maybe your next target is $85, and maybe your stop is going to be at 95.50. And so, what I like about the way this one lays out is visually the entry, the target, and the stop work with the direction of the trade, and I like that. I also like the fact that you've got on one piece of paper, you got everything you need for an entire week of trading plan for this particular trade. So, make up a stock here. It's not the right price range, but it's the ticker that comes to mind. So let's say you're trading Amazon. You do your entry, target, stop Monday, Tuesday, Wednesday, Thursday, Friday. You have any notes that you wish to make, and throughout the week, you can update those notes. And then you can always, down here in the bottom left corner, I got the 5 steps to confirmation, support and resistance, chart patterns, candle patterns, moving averages, indicators, and you can just check through. Did I check these? And so as you're doing your analysis, as you're thinking about any notes you want to make, you always have that 5-step to confirmation checklist right there in front of you. And that's easy to work with. Now, for some people, they like that journal. I have personally found that this is one of the best journals that we've put together. I really like working with this particular one, and it will work very well for you. The downside of this one is every stock gets a separate piece of paper. That can be good or bad. I don't know that it's a specific downside, but that means if maybe you're tracking 10 trades, you're going to have 10 pieces of paper per week that you're dealing with. And for some people, that would be annoying. I actually don't mind that necessarily, but for some people, they may not like that. I've had several people ask if we would put this into like an Excel spreadsheet formation. If somebody wants to do that, we'll be happy to distribute it. As I've already mentioned, I'm not a fan of electronic documentation. I'm just not a fan of that. So I've never gone to the trouble of doing that. But anyway, this is a journal. This is, of all the ones we've worked with, I think this is probably my favorite one. But again, that's a personal opinion. Now, in your notebook, at the back of it, there's several variations of alternate journals. Those are all journals that students have submitted. This particular one is one that we put together, but all the ones in the back of your notebook, except for these 2 that I've shown you, are journals that various students have submitted. So you're welcome to play with any of those and use them as you wish to. Students said we could use them, and so that's why we did that. All right, now that you've kind of had that as a basic intro, by the way, let's come back to this picture of the journal. You realize how simple this is? I mean, this is a really simple journal. It couldn't be as simple as for a bullish trade, there's none, and for the bearish trade, I've got whatever my numbers were. 94 is my entry, my target's 85, and my stop is 97. It's really that simple just to have an entry, a target, and a stop. But how much more prepared are you having this information going into a trade? I mean, seriously, this is not complicated, but it's extremely valuable. And that's what I wanted to point out to you there. So, all right, let's talk about planning your trade. I got a comment on Dale's comment. Dale says, Jeremy, you have to get into 2014. Everything's electronic. Dale, I get that. I really do get that. I'm just telling you, I personally, and I'm not really that old, but I'm kind of old school about these kind of things. Sorry. I mean, if you want to do an electronic version, I don't care. Be my guest. All right, let's talk about planning the trade. Here's the first step in planning your trade. Dinesh, you got to do your analysis. Every trade has to start with analysis. How many of you guys saw our survey that we just sent out asking about Black Friday new products? Did any of you guys take that survey? It's not a big deal if you did not take it. But if you did take it, I find this interesting because I was looking through a lot of the comments, and I wanted to mention this in case some of you made these comments. I'm amazed at how many people say, I really wish I had a class on picking a stock. Do you realize that the class on picking a stock is a class on the wrong subject? How many of you, if I said, I'm going to teach a class on how to pick a stock, how many of you would sign up for that class? That is the wrong class. The class is not about picking a stock. The class is about analyzing a stock. There's a reason I don't sit here and teach you how to scan. You don't need to scan through 8,000 stocks. You need to take a handful of stocks and analyze them and track them. It is a much more profitable way to trade over time. And if you'll let the process work for you, it will actually save you time rather than you feel like you have to spend all this time scanning and searching for stocks. But there's a myth out there, kind of like the myths that the market makers are running your stops. Well, there's a myth that you got to, weed through the 8,000 plus stocks in the market to go find a trade. And that's a myth. You don't have to do that. All you need is a handful, 10, 15, 20 stocks is all you need to trade. I can almost always find all the trades that I wish to do on our top 10. Honestly, I have our top 10 that we look at in our power traders, and, with very rare exception, I hardly ever deviate from that. I deviated from it last week because a friend of mine had turned me on to a trade, and I looked at it and I said, well, that one's too good to avoid. But most of the time, I just stick with that top 10. Sometimes I'll flip over to the top 40 list, and I may find something in there. But you really don't need to spend lots and lots of time harvesting trades. There's plenty on what you've got in front of you. What you got to learn how to do is do the analysis. So do your analysis. What do your moving averages tell you? Are your averages telling you that you're bullish? Are your averages telling you that you're bearish? Or are your averages telling you that there's no trend? What is it? What are your moving averages telling you? And then look at your line analysis. What does your line analysis tell you? Does it tell you that you're bullish? Does it tell you you're bearish, or there's no trend? Is your line analysis telling you that you're at a pivot point? Or is your line analysis telling you that you're ready for a new trend? Is it telling you you're running into support or running into resistance? Is there anything that you need to watch out for that you can take from your line analysis? These are just 2 types of analysis. I'm going to ultimately teach you 5. You saw the 5 steps there in that journal. We've got line analysis, we got moving averages, chart patterns, candlesticks, and then ultimately our indicators. But just looking at these 2 tools, do your analysis. What does our analysis tell us? And based on what you have learned in the last 4 classes and the last 5 classes, you should be able to get about 80% or 90% of the way down the trade analysis just by using your moving averages and your line analysis. You do not have to go out and scan through 1 million stocks. I should be able to pull up any stock here, and we start doing analysis on it, and by the time we're done, you're going to know, is there a trade here, yes or no? Does that make sense? Now, once you've done your analysis, and this is an abbreviated analysis because we're right at the beginning of the program. We're in level 1. When we get through level 2 and we've got the chart patterns and the candlesticks and the indicators, when we get through all that, we'll expand this. But for now, let's just keep it simple. Do your basic analysis with your moving averages and your line analysis. Answer the question, am I bullish or bearish, or is there no trend? Am I at a pivot point? Am I ready for a new trend? Am I running into support or resistance? Is there anything I need to watch out for? Once you've done that analysis, you ask yourself, which direction am I going? After you've done the analysis, you got to pick the direction. And there's only going to be 3 directions: up, down, and sideways. And Dinesh, if the answer is this trade looks like it's going up, then you got a bullish trade. If the answer is this trade looks like it's going down, you got a bearish trade. And if the answer is this trade looks like it's going sideways, Dale, what do you think you should do with that sideways trade? What do you think you should do? You should probably leave it alone because you don't have the tools. I've not given them to you. You might have them from another resource, but from me, you don't have the tools yet to trade a sideways market. So if it's a sideways market, you should probably leave it alone. Later, when we get into some option trades and we get into some opportunities where you can sell against a sideways move and make some time decay profits, well, maybe we trade a sideways move. But I would prefer to see you trading the trend, honestly. I personally prefer to trade trends. That's the majority of what I like to trade. And for most people, the trend is going to be the most profitable move and the one that's the most fun to trade. All right, so once we've done that, we've done our analysis, we've picked our direction. Now what do you need to do, Anthony? What's next? You got to pick a strategy. Now, the strategy at this point is simple. Do you see what's happened? We've done this logically rather than emotionally. Anthony, if I were to tell you I got the perfect strategy class, I need you to sign up for it, you'd probably sign up for it. That's why so many people are out there selling you classes on strategy, and they don't talk about the guts of trading, because strategy is the sizzle that sells. But, Anthony, now you already know what you need to do because you looked at the analysis and you were able to pick a direction. Now that we've looked at the analysis, now that we can pick a direction, Anthony, the strategy's simple. If we got a bullish trade, what are you going to do? I can buy a stock long. If we got a bearish trade, what are you going to do? I can sell a stock short. We got two strategies so far, and we've only got two directions that we're looking at, either up or down. If it's a sideways trade, we're going to ignore it for now. Now, later, we can flesh that out. But for the short term here, as long as we're trading stock, we're just going to be buying stock long or selling stock short. We're buying long if we're bullish. We're short if we're bearish. And we do not have to go out and read 1,000-page strategy books to get there. We don't have to do that, do we? No, all we need to do is do the analysis and pick a direction. I tell you what, guys, if you'll learn those two steps before you get bogged down in strategy, you will save yourself so much headache and so much financial pain, because you can have all the strategy in the world, and if you do not have the analysis, all that strategy is worthless. The way that you make money trading is to do the solid analysis, be able to pick a direction, and then the strategy takes care of itself. Now, what if you want to trade options, Anthony? If you want to trade options, great. I got a bullish trade. Which way are you going? Well, I got to buy me some calls. I got a bearish trade. What are you going to do? I'm going to buy me some puts. Those are your basic option trades. We're going to deal with options coming up. In fact, the next two classes are going to deal with options. But for now, let's keep it really straightforward and really simple. So the first step in doing our plan is do the analysis. The second step is what? Somebody tell me. I forgot the second step. We do the analysis, number one. No, what's number two, Dale? Second step in doing our plans, pick a what? A direction. Okay, so we're going to pick a direction. That's right. Now, what's the third step? We got to choose a strategy. Now that we've done the analysis, now that we've picked a direction, now that we can choose the strategy, now it's easy. We just write the plan. And all we're doing is we're writing the details of what we've just discovered. We looked at our analysis. We figured out which direction we were going. We can look at the stock. We can determine our entry, our target, and our stop. We know the strategy that we're going to be using. We write it down, we document it, and we just go execute the plan. This is, to be candid with you, a boring process. This is also the way you're going to make money. One of my great mentors has said it this way. He says, ordinary things consistently done creates extraordinary results. Ordinary things consistently done creates extraordinary results. I think far too often that people end up losing lots and lots of money because we're trying to be superstars, because we don't want to do the ordinary things consistently, but we want to do extraordinary things from time to time. We call that playing the lottery. It's extraordinary to go out and to buy a lottery ticket and to go win $5 million. It's so extraordinary that it's rare that it occurs to an individual. And when it occurs to an individual, it usually doesn't happen twice. That's extraordinary. I think far too many people are trying to be extraordinary from time to time rather than consistently being ordinary. And the quote says, ordinary things consistently done creates extraordinary results. Keep it simple. Keep it boring. And guess what you're going to have? You're going to have the results that you've been longing to have. All right? But if maybe you feel more significant if you do the extraordinary route, but you just may not have the financial results. And I'm okay with that too. I'll give you a hug. I'll tell you you're a good person. You're just not a good trader at that point. We got to be disciplined about it, and we got to do the ordinary things consistently. All right, so let's do one of these. Let's get over here to a trade setup. And this is a trade setup on the QQQ, but I tell you what, Dinesh, it doesn't matter what the trade is, does it? In fact, fact, Dinesh, just to prove my point, I'm going to take a trade from you tonight. You figure out which ticker you want me to look at, and later tonight I'll take your trade and I'll pull it up and I'll do a trade setup on it for you, okay? So you figure out which ticker you want me to look at, and I'll do that just to prove my point that we don't need to go scan stocks, but rather we need to learn how to do the analysis on the stocks that we've got in front of us. So let's take a look at this trade setup on the power shares, the QQQ. We've got a sideways move here, and if we just throw on some basic support and resistance, we'll throw some resistance at the top. We got some resistance coming in here about $65 and some a little bit below 62 and 60 and down at 54, and you can see all the chart that's on there. If we throw those lines on there, we've basically got our standard grid that we typically would trade through. Now, we can look at this, and we can make some pretty obvious observations at this moment. Most recently, during this time period, we've been stuck. We've kind of been going sideways here. Now, this is after the March highs here. This was our higher high, and most recently, we've had a lower low and a lower high up here. So, you know, if this trade breaks down, we're confirming a bearish reversal, and yet at the same time, if this trade breaks bullish, we're probably confirming a continuation of the trend that has been in play up until now. So truly, we're in a neutral trade setup here. It doesn't matter which way this trade goes. So how are we going to do this analysis, or how are we going to do this trade setup? Well, I'm not quite ready to do the full setup. I want to look at another tool. What's the other tool we've learned to look at, Dinesh? What's the other one? Besides our line drawing, I could probably set the trade up on this picture alone, but I want to also check my moving averages. Thank you, Leon. So let's look at the averages. What are the averages telling me? Guys, I'm getting amnesia here. I forgot. How do I interpret my moving averages? Someone please tell me. I forgot. What are they telling me? My brain's not working for me. Leon thinks it's a channel. Yeah, I'll give you that, Leon. What else are we getting from the moving averages, though? What are the three pieces of information we're looking for from the averages? We want to know if the stock is going up, down, or sideways, and the averages will help smooth that picture. And so what are the averages telling us about the stock trend? Yeah, it's telling us that we're going sideways. Thank you very much, Keith. We're trending sideways. Now, if I did not put that picture on there, how many of you would have thought we were in a downtrend, and how many of you would have thought we were in an uptrend? Just go ahead and tell me. I need to know so I know what we're dealing with. I won't judge you. I just want to help you see the trade through a more neutral perspective. Okay? How many of you look at this picture and all you see is, wow, I'm going down? If you look at this picture and you think this is a downtrend, go ahead and type it in, downtrend or down or bearish or something like that. Okay? If you look at this picture and all you see is uptrend, and I've retraced, go ahead and type that in, uptrend, and then that way I understand where you guys are at. Okay, now, what I'm wanting you to see is both of you, if you said it was a downtrend or if you said it was an uptrend, both of you would have been right. Neither of you were wrong in suggesting that the trade had retraced down to a previous trend line and was ready to move bullish. That would be true. And you also would have been correct if you said the trade has sold off and we've rallied and we're ready for a continued sell-off. Either answer would be true. But what we would be missing there is the reality. The reality is that the trade has gotten stuck going sideways. And while you can tell that from your line analysis here, your moving averages do the best job of all, because you see how the averages are moving right through the middle of the price action of the ETF in this particular case, and the stock price is going up and down, right above, right below, right above, right below the moving average. And most importantly, the angle of the averages is going exactly to the side. Do you guys see that? Okay, can you see that? So, what I'm hoping you can see as I've talked through that is the way that I look at my analysis. We've got to ask ourselves, when we do an analysis, what is the other side thinking? If I'm looking at this and I'm bullish and I see the higher highs and the higher lows and I think this is an intermediate retracement and it's ready to move bullish, if I think that, then I need to ask myself, what's Tim thinking if he's bearish? Because Tim may be shorting the crap out of this thing, and Tim may be in the majority. You see what I'm thinking? Now, what if you're Tim? If you're Tim and you're thinking, hey, this is a lower low and a lower high, this thing's ready to break bearish, Tim needs to be asking, what's J-Dub thinking? He sees that this is a bullish trade. What's Jeremy thinking? And if you will learn to put yourself in the other person's shoes, if you'll learn to ask yourself, what is my opposition, the counterparty thinking? If I'm buying, they're shorting. If I'm shorting, they're buying. What would they be looking at in this situation? That doesn't mean you need to second guess your analysis. It just means that you're opening yourself up for an alternate analysis or an alternate perspective. And if we step far enough back and we use the tools like the moving averages, we get an incredible insight that, wow, neither one is right. We are completely neutral. Now, understanding that we're completely neutral, how would we set this trade up? Well, we can put a trigger in here and we can say if the QQQ breaks above resistance, then who's going to win this battle, the bulls or the bears? If the QQQ breaks above resistance, who's going to win? The bulls are winning it. And where's our next target going to be? Right up in here. That'll be our next target. And where should our stop be? Our stop's going to need to be just below support, which would be putting us about 64.50 or so. Do you see how I just walked through that trade setup there? Dinesh, I'm not picking on you. I'm only using you as an example because you voiced your thoughts about the need to scan. And Dinesh, here's what I want you to see. Far too often, people will miss this incredible trade opportunity because all they see is the stock is stuck. If the stock is stuck, people will say, I'm not going to trade it. And Dale had it right. Dale wrote in and he said, but we can still do a trade setup. And Dale was absolutely correct. We can still do the trade setup on this trade. That's what we're doing right now. You see, whenever a stock is moving sideways, the truth is that the stock in that sideways move is probably giving us the best gift that we could have because it's come to a resting point and we know it's going to break either bullish or bearish. And when that happens, we've got a huge money-making opportunity. Because at that breakout, whether it's bullish or bearish breakout, it's probably the beginning of a new trend. If you go back in time and you look at what actually happened on this breakout, eventually it took another month or two, but eventually the QQQ along with the NASDAQ broke out, and we not only traded to 68.43, but eventually we traded to around $70 a share. So the bullish trade was the correct trade. But we didn't know that at this time. So if we wanted to set up a bearish trade setup, how would we set the bearish trade setup on this trade? Well, I don't want to go bearish as long as I'm stuck between support and resistance. So I need the trade to break below support. So my bearish entry needs to be somewhere down here, maybe around 61.50 or so. And my stop needs to be where? Does my stop need to be below or does my stop need to be above? It's a bearish entry. My stock needs to be above. It needs to be above resistance. So we'll put our stop up here, maybe around $62, and our target number 1 will be 60. Our target number 2 will be about 56.50, and then we got a third target down here around $54. Let me answer some questions that I see coming in here. Ivan says, so are we waiting to break through the channel or trade sideways? We're waiting for the pattern to break, Ivan. What I want to see happen, yes, you could, if you wanted to, try to buy here and sell up here. You can do that. You can play that game. But what I want you to start understanding, I taught you the basics of a channel, Ivan, so you could understand support resistance behavior. The real money on this trade is not trading the channel. The real money is trading the breakout when that consolidation completes. When that consolidation is done and the pattern breaks out, it's either going to be bullish or bearish, Ivan. And when that happens, that's going to be where the real money comes flowing in because that's where the momentum comes flowing in. So what we're really looking for more often than not is the break of the pattern. Somebody asked the question, let me see who it was. It was Kevin. He says, why not just buy bullish at the lows? Kevin, that's a great question, and let me address that for you. Here's Kevin's question. Kevin says, why not buy right here? And here's why, Kevin. Because you're buying when the stock is telling you that I'm going lower. Now you're thinking, well, I'm at support. It's probably going to be going up to 65. And if that's your trade, then you might be correct on that. But far too often, Kevin, what people do is they try to pick the low. Okay, and so people are trying to pick the low. They're buying at 62, and their target is not 65.28. Their target is up here at $70 or higher. And they're thinking, I'm going to pick the bottom, and I'm going to ride this whole thing up. Kevin, which one do you think is easier to make money on? Do you think it's easier to make money when the stock is fledgling right here, and it may be breaking bearish and confirming a new bearish trend, or it may be going up? You don't know because you're at a pivot area. Do you think that's easier to make money? Or do you think it's easier to make money when the stock is traded up and it breaks out and we see the new momentum coming in and we're just very quickly going from one pivot area to the next? Which one do you think is going to be easier to make money on? Probably the latter. See, what happens, Kevin, is far too many people will try to buy down here at the bottom because they're trying to anticipate. That is speculation, though. If you're buying right here, I'm not saying you're wrong, because oftentimes, and I will do this from time to time if the indicators suggest it, oftentimes you can buy here, your stochastics are saying that the trade's going up, and then we get up here and they say we're going down, and you can trade the channel. That is a realistic trade. But, Kevin, what you got to watch out for is the temptation to try to pick the bottom and then hold this trade until it turns well for you. And what often happens, Kevin, is you get into that trade, you start buying here, the stock breaks bearish, and then it's going from target to target, and you're holding on for dear life, asking yourself and maybe praying day and night, God, please let this thing come back to $62 so I can get my capital back. When it was as simple as saying, you know, this trade has already set up a lower low. It's already set up a lower high. I'm back at my pivot. If I break bearish, the odds are this trend is continuing. Later, you'll learn that this is a third wave. It's probably going to be a really strong wave if it continues bearish. And you probably had $8 or $10 on the downside if that trade confirmed. Does that make sense, Kevin? So it's all a matter of perspective. Now, a lot of people will tell you, buy when you get to support. I just don't do that, because what I like to do is I like to buy into the momentum. I like to buy after I break out of resistance and it's telling me my trade is going. I like to sell short or to buy puts after I break through support and it tells me that my trend is going. What happens, Kevin, is more often than not, I'll be able to do that. I'll get into a trade, and very quickly, if not that day, within a day or two, I'm sitting on some nice profit, and I'm not sitting there holding and hoping during a pivot area while it's trying to figure out which way it wants to go. Does that make sense? Did I bring some clarification for you there, Kevin? Yeah, Kevin says that buy the dips is something he's heard very frequently. Yeah, and that's because a lot of people will do that strategy. But what ends up happening, Kevin, is a lot of people will be, you know, every time we get up here to resistance, people start shorting, and then it comes down here and it rides back up, and they're like, well, what's going on with it? Or it breaks out and they get stopped out and they get all frustrated because they're trying to guess. You know, Kevin, what I like to say is I like to say that a bracket trade like this, what it does is it limits us to the trades that we actually want to get into. It's that final piece of confirmation, Kevin. It is buying into the momentum rather than hoping for the momentum to come. Does that make sense? Yeah. All right. Let's take this trade setup that we've just done and let's put it over now onto a journal. Let me make sure Kevin's taken care of here. I'm not just talking to Kevin, by the way. Did you guys understand more why I set this trade up the way I did? I'm hoping that all of you are learning from this. I just like to pick on Kevin because he brought the question to me. Of course, right? But you guys are understanding this, right? Okay, great. Let's put this over here onto a trading plan now. So all we're going to do, we've drawn this thing out. Notice, Kevin, we did not do this based on numbers. We did this based on the visual. This is a really important distinction to the way that I trade versus the way that most people trade. Most people are going to try to trade this in a very scientific manner. That's why very analytical people, such as, say, an accountant, scientist, mathematicians, engineers, people of that disposition have a hard time trading sometimes because trading is more art than science. Likewise, musicians and artistic people, which, most of you know I was a musician before I started doing all the trading that I do. A lot of artistic people really understand this because it's very visual and it's a little more art than science. Now, the danger of that is the artistic person doesn't usually have the discipline that the scientist has, and the scientist doesn't have the artistic understanding, interpretation that the artist person has. So I think trading is a great opportunity for everybody to grow. If you're a little more organized, it's a great opportunity to learn to be more flexible. And if you're a little more flexible, it's a great opportunity to learn some discipline. Either way, you got some opportunity to grow. But here's what I'm wanting to point out here. This is a visual approach to trading. I'm not trying to say we're going to enter at $66. $66 is the right point because visually speaking, that's when we have broken out of resistance. Does that make sense? Do you see how I'm getting to that outcome? Okay, if you try to be scientific about it and say, well, the stock was trading at 62, how did he come up with 66? You're going to just go nuts. There's no formula for this. The formula is we enter the trade after we break out of resistance. Where is that? That's about $66. So we're just going to put that on our bullish entry over here. We're trading the QQQ. On the bullish trade, we would enter the trade. This is on 726. We'll enter the trade at, the current stock price at that point was $62.54. There we go. Enter the trade at $66. I knew this slide would build like my mind one day. Our target is $68.20, and our stop on this trade is $64.50. Now, you may notice right here that this is not a great risk-reward. It's okay, but it's not phenomenal. And when we get into risk-reward, you'll understand that. But right now, I'm not worried about risk-reward. I just want to show you how to set the trade up. So let's stick with that component of this, all right? So let's look at the bearish trade. On the bearish trade, we would put our entry down here at $61.50 because that's where we figured it went. Again, this is not a scientific answer. This is a visual answer. We break below support. We enter the trade approximately there. That's about $61.50. Our target on this trade ends up being about $59.75, and our stop is $62.25. Boom. There's your first trading plan based on this particular trade interpretation. Does this help you guys? How many of you understand that? And if you've got any questions about that component, this would be a really great time to ask it. Gary's got a question. He says, how many false breakouts do you get? I don't have a number, Gary. I don't think that's the right question. I think the question you're trying to ask is how frequently do they occur? What are you really trying to ask? You want to know how common it is that you get a false trigger, or it happens, Gary. I mean, I would be lying if I said it didn't happen, but as you practice this, Gary, as you do the trader conditioning process, you'll get better and better at setting your entries, and you'll get fewer and fewer false triggers. It still happens to me. I mean, it still happens, usually at least once or twice a month I'll get one, but it's not like it's every day. I don't know if I can give you a scientific answer to that. I feel like I'm not serving you very well, Gary, but I'm answering as honestly as I can answer right now. Okay, Dale asked a question. He says, all about more winners than losers. That's right. It's about more winning trades than losing trades. And, Gary, maybe this is the better question. It's about having a better risk than reward. And, Gary, when you set your trades up with the right risk reward, you kind of don't worry about some of the false breaks because they're going to offset. And over time, you're going to have more winning trades, and you'll be making more per winning trade. That's really what you need to be focusing on when we get into the actual execution of the trades. Okay? All right. Let's talk about executing this. And Dinesh, I'm going to take your trade at the end of class, whichever one you choose to look at. So I don't know if you've got that ready for me, but we'll look at that. All right, so we're going to take this trade setup. We've just done a bullish and a bearish trade setup on this. And when you do this in your actual trades, I wanted to do for this example, I wanted to do one where we had both a bullish and a bearish trade setup. More often than not, if you're trading a trend, one of these, you're going to write the big letters none for one of them. Either the bullish or the bearish trade. Sometimes you'll get a nice neutral trade setup like this, and you could actually go wait for a bullish or bearish trigger, and you're set up either way. Sometimes that happens. But more often than not, there's probably going to be one position, either bullish or bearish, that is more predominant, and that's probably the one you're waiting for to confirm. For example, this morning, I got into some bearish Caterpillar trades. It was a trade that we talked about in Power Trader Sunday night, and I didn't have a bullish trade set up for Caterpillar. So when the bearish trade triggered, that was the only trade that there was to do, because I'm not sitting here waiting for it to decide. And most of your trades are going to look like that. Does that make sense? I want to throw that out, but anyway, for this example, I'm doing both bullish and bearish. Maybe that was a worthless tangent. Let's set this thing up into an order form here. So what you're going to do with your order form, you want to usually, if you're going to set a trigger, and most of you are going to want to trade with a trigger, if that's your case, you probably will need to use a market order, because you don't. Well, if you're trading stock, you can set a limit order, but if you're trading options, you're going to have to set a market order, because you don't know exactly the option price when that trade will get triggered. So this is the way you'll do it. You'll set your action up. This is going to be a buy. Let's say we're going to do 100 shares. We'll do this for a day duration. It really doesn't matter. You can do either one. And then there's your market order. Now, when we get ready to preview this, what we need to do is we need to select the button that says trigger. This is how we set the criteria up. Boom. When I select that, watch what happens here. Here's all your criteria. The condition is the last price of my symbol is greater than $66. That's my entry. Okay, this is how you get the computer to execute your trade for you. You set your trigger. If the last price is greater than $66, then what? Well, then execute my order, which is what I set up on the last page, and I'll go back to that so you can see it. My order was to buy 100 shares of QQQ at a market price. Well, when do I do that? Right now? No, you do it when this condition is met. When the last price of the QQQ is greater than $66, then send my order to the floor, and my order is to buy 100 shares of QQQ stock at the market price. It's a day order. And then you're going to hit preview, and you're going to answer all the confirmations, and you are done. I want to stop right here, because this is one of the most simple things that I'm going to teach you, and yet it's one of the things that I get people really confused on, and I want to make sure you're clear. Do you see what I have just done? All we did is we set a trigger or a contingency order to trigger at our entry price, and then the order is going to just be a market order. It says go buy the stock at that price. That's all it is. And what that does is now when you hit send, it's going to go to your broker, and it's going to stay on the server. It doesn't go to the floor. The market maker does not know this order exists. When those criteria are met, the broker's computer will send that order to the floor, and then that order will get filled. That's how you trigger a trade. Now, Roxanne says, well, can I use a limit order? You absolutely can use a limit order. Yeah, you can use a limit order. You could have said use a limit order of 6602 or whatever you want to use, Roxanne. You can certainly do that. With an option trade, it's a little more complicated, because you don't necessarily know what the option price is going to be. I hate it. I absolutely hate it when computers start trying to make me upgrade. I want to be antiquated. All right. As I was saying, Roxanne, when you're dealing with an option order, you don't know exactly what the option price is going to be. But, with a stock order, you're going to know, because that's what you're setting the trigger on. So you could set a limit order and say 6602. The truth is, Roxanne, If you set a market order, it's going to get filled, and it's probably going to be filled within 2 or 3 pennies, Roxanne. And the only time the limit order would probably benefit you with that stock trade is if either A, there's hardly any liquidity, and you probably will not be trading a stock like that, or B, if you're doing literally thousands and thousands of shares. If I'm trading, $2 million worth of shares, then a limit order is more practical, Roxanne. If I'm trading 100 shares, the limit order almost doesn't matter. And I don't want to be dismissive of it, but I'm just saying that you send 100 shares to the floor, and it's going to get filled really quickly, and you're not going to have that massive slippage. That's what I'm trying to say. Okay? I think I answered Roxanne's order. Any other questions about that? All right. Yeah, Michael says, so is the order ticket on your software from your broker? This particular screenshot, Michael, is from Options Express. I personally have been trading with Options. I'm sorry, I just lied. This screenshot is from Options House. I personally have been trading for the last several years on Options Express. I am about to announce next week that I'm switching brokers, and I'm doing that because of the price of the commissions. But yeah, any broker is going to have a similar setup here, Michael. And this is just your basic broker order form here, Michael. Yeah, that's all it is. This is an Options House ticket, yes. Okay. All right, let's move on. Let's look at a short trade.